Zach Corp purchased depreciable assets costing $600,000 on January 2nd, 2020. For tax purposes, the company uses CCA in a class that has a 40% rate. Assume these assets are considered eligible equipment for the purposes of the accelerated investment incentive. Under the AII, instead of using the half-year rule, companies are allowed a first-year deduction using 1.5 times the standard CCA rate. For financial reporting purposes, the company uses straight-line depreciation over 5 years. The enacted tax rate is 30% for all years. This depreciation difference is the only reversing difference the company has. Assume that Zach has income before income tax of $340,000 in each of the years 2020 to 2024. And the first thing we're asked to do is calculate the amount of capital cost allowance and depreciation expense from 2020 to 2024, as well as the corresponding balances for undepreciated capital cost at the end of the depreciable assets at the end of the years 2020 to 2024. Okay, so let's do that. So we're going to have depreciation versus CCA. So to do that, let's simply run our years down this to the side. So we're going to need to go out to 2024, just as the question says. Okay, and then here we're going to have depreciation. We're going to have net book value. We're going to have CCA and UCC, which is essentially our net book value for tax, and the difference. So let's also put the purchase price of the asset here, which is $600,000. Okay, so our depreciation is simply going to be $600,000 divided by 5. Because of the fact we're assuming that there's no residual value because we're told that there isn't one, and it's straight line depreciation over 5 years. So we can just drag that down. Our net book value is going to be the purchase price minus the depreciation taken to date for the first year. And for the second year, it's going to be opening net book value versus the depreciation for the period. Opening, so here, sorry, 1 second, net book purchase price minus the depreciation taken to date. There we go, and we can just drag that down. So you can see that at the end of the 5 years, we end up with 0 net book value, which makes perfect sense. So for CCA, we're going to take the purchase price times the rate. So it says it's a 40% rate, but we need to remember that for the first year, we're told that we're part of this AII deal where we can use 1.5 times the regular depreciation. So I'm simply going to add and multiply it by 1.5 times. That gives me my first year of CCA. My UCC is going to be my purchase price minus my CCA that I've taken to date for the first year. The next year is going to be, my CCA is going to be my UCC times the rate. It's really important to remember we're multiplying the UCC times the rate. And then my closing UCC is going to be my opening UCC minus the CCA taken for the period. So same thing here, I'm going to take UCC times 40%, or opening UCC, I should say. Closing UCC is opening minus CCA for the period. And it continues on like that. And oops, this one is going to be this times 40%, and then my UCC is going to be here. So what you can see is that at the end of 2024, we fully depreciated that equipment for the purposes of accounting depreciation. But for tax, there's still an undepreciated capital cost of $31,104. And CCA goes on oftentimes longer because you're taking the UCC times the rate. So as it decreases, your CCA decreases each year, so it can take longer to depreciate. However, we can stop the schedule at 2024 because that's what we're asked to do in the question. So the difference here is going to be my depreciation versus my CCA. So you can see my CCA was higher than my depreciation, so I'm going to get a negative, and so on. So those are my comparisons between depreciation and CCA. Of course, these differences are going to reverse. So if I run a remainder column here, I don't have anything else to depreciate from accounting purposes, but I do know that in the future, at some point, I'm going to use this amount as my UCC, or as my CCA, I'm sorry. So my final UCC will be 0. So if I run a sum here and look at how much I've depreciated over time and how much I was going to go through tax over time, we're going to recognize, sorry, we're going to have the entire 600,000 depreciated either way. It's just a timing difference. So you can see that I'm going to expense 600,000 for tax, and I'm going to expense 600,000, sorry, for accounting and for tax. So it's simply a timing difference. That's how we know it's a reversing difference. So that completes A. We've made our schedule of depreciation versus CCA. Next, we're asked to determine the amount of taxable income in each year from 2020 to 2024. Now, we don't have taxable income. Right now, we only have income before income tax. So let's do that. B is taxable income rec. So we're going to have our accounting income here. And we're going to run the years across the top because we have multiple years. So we've done a lot of accounting to taxable income recs, but we haven't done that many for quite a few years at a time. So the best way to handle that is to run the years across the top. In the question, we're told that for financial reporting purposes, Zach has income before income tax of $340,000 in each of the years 2020 to 2024. So we're going to have constant accounting income here of $340,000. We're going to run that all the way across. Okay, now we're going to have our reversing differences or our taxable differences. So this is really CCA versus depreciation. So here I'm going to pick up the differences. So here my depreciation for accounting purposes was lower than CCA. So I'm actually going to reduce my taxable income because I can take a bigger deduction for tax. So my taxable income is going to be the sum of accounting income plus the adjustments. So you can see here that my taxable income was, or my accounting income was $340,000. I was able to take this extra depreciation for CCA because of the AII rules. So now my taxable income is only $100,000. For the next year, my depreciation for book purposes was 120, but my CCA was only 96. So I'm only allowed to deduct 96,000 for tax, but I've already deducted 120, means I need to add back 24,000 to my taxable income because I've taken too big of an accounting deduction versus what's allowed for tax. And similarly, as we go through, except for the year with the AII, our depreciation is higher than our CCA. So we're adding back the difference. And you can see how that changes our taxable income here. Now, to calculate our income tax payable, we need to apply the tax rate. We're told that the tax rate is 30% in all years. You could have different tax rates that you're applying here by year, and you would simply change it there. So income tax payable is going to be this number. Going to be our taxable income times the tax rate, and that's going to give us our income tax payable. Okay, so that gets us there. So C says determine the amount of deferred taxes that should be reported in the statement of financial position for each year from 2020 to 2024. Well, our statement of financial position is a balance sheet or statement of financial position view, of course. So we've calculated our taxable income piece, and this is going to be our current tax expense. Now we need to figure out what we have for deferred taxes. So what do we owe in the future? So here we want to compare, we can put this here, C, deferred taxes. So here we want to compare the net book value. So this is going to be net book value versus UCC. So what we want to do is say, well, our net book value in year one is 480 and our UCC is 240. Our net book value, our UCC for tax purposes minus our net book value is going to give us 240,000. And let's talk about what these numbers mean in a second. So this means that I can take, so here I've got depreciation of 120, but I've taken CCA or my net book value is 480, but my UCC is only 240. So I've taken that much more deductions for tax. So in the future, I'm going to have that much less tax that I can, or less deductions that I can reduce my taxes by, because ultimately we're getting back to that 600,000 either way, right? So I've taken more deductions for tax here. That means that I'm going to have more tax liabilities in the future because I'm going to have less deductions. And same thing here. So here my UCC is, my net book value is 360, but my UCC is only 144. Same thing. It means I can deduct that much less for tax because the most I can deduct is the 600,000 over the whole thing. So therefore, I'm going to have more deductions in the future. Less deductions in the future. And similarly, and so on here. Here you can see, though, that my net book value is 0 and my UCC is 31. That means I can deduct the 31,000 in the future from tax. Therefore, that is actually a tax asset. Okay, so those are my taxable amounts. Now, it's really important to remember, though, that there is a continuity here. So this is going to be the change in net book value. So this is going to be then we apply the tax rate here. So this is the difference, and we're going to have the tax rate running. So we're going to have 30% running through here. And then this is going to be my deferred tax. Let's put this here. For illustration purposes, we're going to put deferred tax, and we're going to have liability asset. So this is going to be 240 times 30%. So this is going to run through, and then we're going to have an asset at the end here, which is going to be this amount times the 30%. Now, it's important to remember that when we record the deferred tax, we need to use the change. Remember the change. So we're not recording the entire amount in each journal entry. We're only recording the change in each year. Okay, so now let's look up to D, and it says prepare the journal entries to record income taxes for each year from 2020 to 2024. Journal entries for taxes for 2020. So for 2020, we're going to have current tax expense. So we're going to have debit current tax expense, credit income tax payable. So this is going to be this amount right from our schedule here where we took taxable income when we applied the tax rate. That's our current tax expense. It's relatively easy as long as you did this rec. Okay, and then now we're going to have our deferred tax. So we're going to have debit deferred tax expense. And this is P&L. And then we're going to have credit deferred tax liability. This is obviously a statement of financial position. So this amount is going to be the tax liability. Let me just expand this out a little bit. So this is going to be the tax liability here that we had calculated, which is the balance sheet difference. So the net book value versus the UCC times the tax rate. And the reason that this is a liability, just ignore the sign there. The reason that this is a liability is because of the fact that we have a higher net book value than UCC, meaning that there's more we can deduct for accounting purposes in the future versus tax purposes, meaning that we're going to have add backs. We have less that we can deduct for tax purposes in the future because we've deducted that much already. Okay, so now journal entry for taxes 2021. So we're going to have the same entry, current tax expense. And of course, we're going to pick up our 2021 number here, this 109,200. Okay, and then our deferred tax, it's going to be the same accounts, but the entry itself is going to be different. So it's really important that we remember, and let's do a little rec here. So we're going to have opening deferred tax, opening, let's say deferred tax liability, is going to be, we started with on our balance sheet 72,000. So then deferred tax before adjustment, deferred tax liability before adjustment. What do we want it to be? Basically, we want it to be this number here, 64,800. We don't want it to be negative. That's what we want it to be. So then we're going to have the change required in the account, which is going to be 72,000 minus what's in there. So we want it to have a balance of 64,800. It already has a balance of 72. So we need it to have a balance now of 7,200 less than what it had before. So we're going to make an adjustment to the account. So we are going to be reducing it. So here we had debit deferred tax expense, credit deferred tax liability. And here we're actually going to be reversing those entries. So we're going to have credit deferred tax liability or debit deferred tax liability, which is statement of financial position. So this is decreasing the liability by $7,200. And then we're going to credit our deferred tax expense. And we actually changed the name to benefit. It's basically the same account, but we just call it benefit. It's really the same account here. We just changed the name from a tax expense to tax benefit, depending on if it's a credit or a debit. So 7,200. Okay, so now journal entry for taxes for 2022. So we're going to have the same current tax expense entry, and we're going to pick up our 2022 numbers. This entry is pretty simple, so we want to make sure we don't forget it, because of course on an exam there would be marks for both type of entries. So we've got this number, and then now we've got our deferred tax. So let's do our deferred tax rec here. We need to really be cautious of the fact that this is the change in the account. So what is our opening deferred tax? Well, it's 64,800. Remember how we had adjusted it to make sure it was that balance. What do we want it to be? We want it to be, let's look up here at our schedule. Now we want it to be 46,080. So get rid of that sign for illustration purposes. So the change required, so this is the balance in the account. We want it to have a balance of 46,080. So what we need to do is make a journal entry for the difference, because this is a statement of financial position account. So now we want to decrease our deferred taxes by 18,720. So we're going to do the same entry that we did before right here, whereas we're debiting the deferred tax liability and we're crediting the income statement. So it's actually like the opposite of a tax expense. It's a tax benefit. And here, this is going to be our 18,720 and 18,720. So we've been reducing our future tax expense each period from what we had first put on the books in 2020. Now we're bringing it down as time goes by. Okay, now let's do, where were we here? 2021, now let's do 2022. So here's 2021, 2022. Now let's do 2023. Journal entry for taxes. We did 2022. So we did 2021 and 2020. Okay, so now we're in 2023. Okay, so we're going to have the same current tax expense entry, of course. We're going to pick up our 2023 numbers. And then what's going to happen with our deferred tax liability? So our opening balance is going to be this 46,080. That's where we had adjusted it to. What do we want it to be now? Let's look up at our schedule. We want it to be only 20,448. So we need to make an entry for the difference. So now we're going to pull it down again by $25,000. So we're going to make the same entry where we're debiting the deferred tax liability and we're crediting the income statement. So it's an income tax benefit on the income statement, not income tax expense. And this is going to be this $25,632 to bring, so that now the balance of this account on our statement of financial position is going to be $24,448. And let's finish this off with 2024. So our last year. So of course we've got this same entry here. Now we're going to pick up our 2024 numbers. Okay. And then our deferred taxes. What's going to happen here? Well, the interesting thing is now we have a deferred tax asset that we need to recognize. So what is that going to look like? So we've got, let's just put this here. So we've got our opening deferred tax liability is $20,448. What do we want it to be? Well, we actually want it to be an asset now because the net book value for accounting is now lower. So our UCC is now higher because we've got 0 net book value for accounting. So we want it to be 9,331. And what's the change required? Well, the change is going to be, this is actually the opposite. So this is where we do want a negative. So we're saying we want it to be that. So now if we take this minus this, we're going to get, we need an adjustment now. We need it to actually increase to 29,772 is the entry that we require because we want this, we need to clear out the deferred tax liability. And now we're going to put on we need to clear out the deferred tax liability, and in effect, it's going to become a credit balance, which is a deferred tax asset. So we are going to have debit deferred tax liability, this number, and credit deferred tax benefit, which is a P&L account. So this is going to be 29,779. And that gets us to where we need to be. So you can see that now we've actually got a contra balance in our deferred tax liability because in our deferred tax liability account, we only had 2448. And now we have 29. So it's actually going to show up as an asset on our balance sheet for the difference, which is going to be 29 minus 24. So you can see now we have this asset, deferred tax asset of 9,331, which is exactly what we wanted based on our schedule up here, where you can see that now we end up with an asset in the last year. The reason that it flipped from a liability to an asset is because what we want is for it to be an asset is we want to have a higher UCC than net book value. And that's because the higher UCC, the more deductions we can take for tax purposes versus accounting purposes in the future. When our net book value is higher than our UCC, it means that we've taken more deductions for tax than accounting, and it means we're going to have less deductions we can take for tax in the future, and that's why we have a liability for the majority of the years. But when the net book value caught up and it became 0, but we still had a net book value for UCC, then we had more deductions. Now we can deduct 31,000 from our taxes in the future, but we can't deduct anything for accounting. So then now this becomes a deferred tax asset.